Every investor has felt it at least once. That moment when a stock jumps higher or drops sharply, even when the rest of the market seems calm. You look at the chart, then at the news, then back at the chart, wondering what on earth just happened. Why do some stocks behave like calm, steady turtles, while others act like wild, unpredictable fireworks? The answer often comes down to one simple idea that many people hear about but never fully understand: beta. A small word, but a powerful one. And the moment you learn what it truly means, the stock market starts making a lot more sense. By the end of this video, you'll be able to look at any stock and predict how it's likely to behave during the next storm or the next big opportunity. You'll even understand why certain stocks feel riskier, even if no one explicitly tells you they are. Stick around, because this is one of the most important concepts beginners overlook, and one that seasoned investors quietly rely on every day. So what is beta? At its core, it is a measure of how a stock reacts compared to the overall market. If the market is a giant heartbeat, rising, falling, pulsing with economic news, then beta tells you how sensitive a stock is to that heartbeat. Some stocks respond strongly, some barely move, and some go the opposite direction entirely. Let's break it down in the simplest way possible. A beta of 1 means a stock moves in line with the market. If the market goes up 1%, this stock usually goes up around 1%. If the market drops 1%, it drops about the same. These are your average middle-of-the-road stocks, the ones that follow the market's mood. A beta above 1 means the stock is more emotional than the market. If the market rises 1%, this stock might rise 1.5% or 2%. If the market falls, it falls harder. These are the high volatility stocks. Exciting, unpredictable, sometimes stressful, sometimes rewarding. Think of them as the sports cars of the market. Fast, powerful, and tricky to control. A beta below 1 means the stock is calmer and steadier. Even if the market swings wildly, this kind of stock tends to move in smaller, more controlled ways. Utilities, consumer staples, or long-established giant companies often fall into this category. They're more like trains, slow, reliable, and predictable. Then there's the rare case, negative beta. These are stocks that move opposite the market. When the market rises, they might fall, and when the market drops, they might rise. Very few investments have a strong negative beta, but the idea is fascinating. Imagine having something in your portfolio that becomes stronger during market downturns. Interesting, right? If you know any examples, drop them in the comments. I'd love to see what viewers think. Now here's where things get really interesting. Beta doesn't just tell you how a stock moves, it tells you how risky it feels. High beta stocks carry more excitement and more danger. Low beta stocks feel safer, but may also offer lower potential returns. But here's a thought-provoking question. Do you personally prefer stability or excitement in your investments? Let me know in the comments. I'm curious how different everyone's strategy is. One of the biggest misunderstandings is thinking beta tells you whether a stock is good or bad. It doesn't. It tells you how a stock behaves, not whether that behavior is right for you. Some investors love high beta stocks because they dream big. Others prefer low beta stocks because they want to sleep peacefully at night. And some like a mix of both, creating a portfolio that balances thrill and stability. A question to think about. If you had to build a portfolio for the next 10 years, would you choose high beta, low beta, or a mix? And why? Share your answer in the comments. Let's see how different personalities approach investing. Now, why does beta matter so much? Because knowing it helps you prepare for the future instead of reacting to surprises. When the market suddenly drops, high beta stocks usually fall harder and faster. Low beta stocks tend to stay steadier. And if you already know the beta of what you own, the ups and downs feel less shocking. You're not blindsided, you're informed. It also matters when you're planning long-term goals. Let's say you're investing for retirement. You might want lower beta stocks that keep your money safer. But if you're young and willing to take more risk, high beta stocks might offer the extra growth you're looking for. Beta becomes a kind of compass, helping you understand which direction your investments might move in different kinds of weather. But let's go even deeper. Consider this. Why do some companies have high betas? Usually because they are affected more by economic news. Industries like technology or entertainment react quickly to new trends, regulations, or consumer shifts. Meanwhile, companies that provide everyday essentials, electricity, food, water, don't swing as wildly because demand doesn't change much. People still need these products even during recessions. Here's another question for you to drop in the comments. Do you think a company's beta says more about its industry or its management? I'd love to hear your thoughts because this question often sparks great debates. Now imagine you're building a portfolio. You don't want everything moving in the same direction at the same speed. That's where beta becomes incredibly useful. Mix high beta assets with low beta ones, and suddenly your portfolio becomes more balanced. One stock zigzags wildly, while another stays calm, and together they create a smoother investment journey. Diversification isn't just about buying different stocks, it's about buying different types of movement. Beta helps you do that with knowledge instead of guesswork. And here's a fun twist most people don't know. Beta can change over time. A company that was calm last year might become unpredictable this year. A startup can mature and become more stable. A giant company can suddenly face new competition and become more volatile. That means checking beta occasionally is like checking the weather forecast. It lets you adjust your plans before the storm hits. Let me ask you this. Do you think companies with rising betas are becoming riskier? Or are they becoming more exciting? What's your interpretation? Drop your thoughts in the comments. If you're enjoying this breakdown so far, make sure to like, subscribe, and share this video for more amazing content. It really supports the channel and helps videos like this reach more curious minds. And if you want more deep, simple explanations like this, hit that notification bell so you never miss out. Back to the topic. Because there's still one more important layer to beta. Beta isn't perfect. It measures historical movement, how a stock behaved in the past. But just like people, stocks can change. A company might diversify its business, enter new markets, change leadership, or shift strategies. When that happens, its beta may slowly drift in a new direction. That's why beta is more like a helpful guide than a fortune-telling tool. Some investors even compare beta to a personality trait. A person might usually be calm but can become emotional when stressed. Similarly, a stock might behave steadily most of the time but react strongly during certain market conditions. Understanding this helps you stay realistic and prepared. Here's something to think about. Do you believe past behavior is a good predictor of future behavior, in stocks or in people? An interesting parallel, right? Tell me what you think in the comments. For many beginners, beta becomes the first step to understanding risk. Before beta, stocks feel random. After beta, you suddenly see patterns. You notice why certain stocks dominate your portfolio during bull markets, but hurt during bear markets. You understand why your friends' high beta picks are exciting but stressful. And you understand why some investors prefer slow, steady companies, even if they grow more slowly. Knowledge turns confusion into strategy. Before we wrap up, consider this. What kind of investor do you want to become? Someone who chases high beta opportunities? Someone who builds stability with low beta? Or someone who strategically blends both? There's no right answer. Only the answer that fits your goals, your personality, and your risk tolerance. Drop your answer in the comments. I'm excited to see the variety of perspectives viewers bring. And if this video helped make beta clearer, don't forget to like, subscribe, and share it with someone who's just starting their investing journey. You never know. This simple understanding might be the key to helping someone avoid a bad investment or make a great one. Thanks for watching, and remember, the more you understand the behavior of the market, the more control you gain over your financial future. Beta is just one number, but it can make all the difference.